Hello and welcome everyone to this short presentation brought to you on behalf of the Academy of Financial Trading. And what we're going to explore today is a very commonly queried topic by our students, and that is the simple versus the exponential moving average. And before we break down both points very clearly and explain to the listener exactly what the difference is, let us take a quick warning. So folks, if we can just familiarize ourselves with the information in front, engage as much as you can, simply so that hereafter any decisions you make are of a fully informed nature. Let us explore both points of the exponential versus moving average. So what is the big deal, folks, and why do we really need to classify these? Well, they essentially measure different values. The simple moving average is the most commonly used retail indicator, and the exponential really is often used among the more advanced trader as a more sophisticated indicator, if you will. So its roots are somewhat different than the SMA. Both are often used, folks, as indications of momentum in the market. And what we say by that, or what we mean by that, is momentum really is how strong a market is moving in a given direction. So of course, if the momentum is strong to the upside, it would mean that we're quite, satisfied that the trend will continue using a momentum-based indicator. And the same, of course, applies to the downside. If sufficient indicators showing momentum warrant us placing a short trade, if you will, or making a decision to speculate upon further shortening, that would be a sign that we're confident of the momentum. Now, these indicators, though, however, are seen as a lagging indicator, so the respective signals are seen to be delayed. To really delve into this and explore it in a lot of detail and hence get a thorough understanding of the same, let us explore both separately. So the simple moving average. And at this point, you might question why there is a popular Simpsons character in front of you on the screen. The reason being, you do not at all need to be of the intelligence of this gentleman in order to understand these concepts. Really, we feel with thorough explanation and clear, comparable explanations of both of these, you can get a clear understanding and essentially understand the differences between the two, how they might be applied differently, and how they can benefit you in your trading. So for the simple moving average, guys, we take the price over the last given period of days and then sum to give us the current value of the SMA. It will be worth mentioning at this point that if we're looking at a 10-day moving average, so a 10-day moving average, let's say, and we're looking at a daily chart, we would observe that the 10-day moving average for the specific day we're looking at will be concerning only the last 10 days. Only the last 10 days. Of course, if it was a 5-day moving average, it would concern only the last 5 days, I should say. So that's really the correlation, if you will, between the name we assign to the moving average relative to what it's actually measuring. And that will then give us the current value of the SMA. Let's work through some examples, though, at this point to really be very clear. So suppose we're looking to trade a very popular commodity, and that is the book. This is not actually traded, guys, in an actual derivative chart or in a capital market, but for this example, it would thoroughly suffice. So suppose then over the last 3 days, the price was 1, then rose to 3, and then rose furthermore to 4. And again, this is over the last 3 days only. What I would then do is I would then add the values of the price, divide it by the amount of days within that, and that would give me around 2.6 if we're rounding in this example, which is the SMA, or the 10-day, or the 3-day SMA, I should say, for this given chart. Again, if we were looking to do it for 10 days, we would simply look back to the last 10 days and divide it by 10 instead of 3 in that instance. And that really is the heart, or the engine, if you will, or frankly the nuts and bolts, guys, behind what actually constitutes the simple moving average calculation. The exponential is somewhat different, and there's a bit more of a smoothing factor, and it's really adjusted for the current price a little bit more. Let us explore exactly how that works. So it's useful to mention really at this point that the exponential moving average is used to capture shorter term trends. The reason being it's more sensitive to the current price, And given how the EMA is used, we can deduce quickly that it is employed by those looking to capture the smaller term trends. So it's not necessarily for the guys looking to stay in the trade for, let's say, 2 months or something. It might be the guys looking to stay in there for a week or even a period of days to capture a pip movement such that they can profit from the same. Now, one might say, of course, then that it has an accelerated reaction or a quicker reaction to the most recent price. So it lets us react that little bit quicker. And the EMA takes into account more so than the SMA the most recent price. So that this essentially the EMA is more quick to react and gives us a better insight into how the market is adjusting relative to the past prices. Both are absolutely comparable in this sense, and we can use a combination of the two for the purposes of confirmation of a signal. And let us see, by exploring a very popular chart, what that looks like in reality. Now in front of us we're looking at a daily chart of Euro US dollar. In green is the exponential moving average over a 21-day period. In blue is the simple moving average over the same period. Can everybody see exactly what's happening, particularly in this recent region where we've seen a bullish move on this chart? Can everybody see what's happening? Can we see how the exponential moving average has adjusted to the price uptrend quicker than the simple moving average? Because the current price relative to the last, period of time is factored in more so in the EMA calculation. So it essentially adjusts quicker when the current price is significantly different from the last recent prices or from the recent prices at all. And that's what the EMA is used to capture. Certain traders might look to use a combination of these, as we have shown here, such that when one of them crosses over, usually the exponential moving average with the other, we might look for possible positions at that time. Because it's crossed over to the upside, this could be seen as a signal for long positions in this given market. Well, that concludes today's session, folks. We hope it's been absolutely helpful. If you have any questions or would like further information, please don't hesitate to get in touch, as we welcome all inquiries, are delighted to be of assistance, and really, as we say here, guys, keep learning.